Hi everyone, this will be our video lecture for Chapter 2, and in Chapter 2 we're really going to focus in on job order costing. Some of the conceptual learning objectives here in this chapter, explaining the cost accounting system, especially like from a perspective of job order costing and job order production. We'll talk about the important features and aspects of a job order costing system. We'll explain job cost sheets and how they are used in job order cost accounting. And in some of the in-class exercises and homeworks, we will prepare job cost sheets and really get into the detail on the related journal entries and other methodologies surrounding job order costing. And then as an outcome of completing that work, we'll kind of like consider our job order costing in terms of pricing our products as well. We're going to describe and record the flow of materials costs in job order cost accounting. So that's going to kind of be captured in some spreadsheets that we work through. Labor costs, material costs, overhead costs. It gets a little tricky in Chapter 2. So definitely this is a good one to pay attention to and practice as much as possible. It's not extremely difficult material, but there's a lot of moving parts to job order costing. And so definitely take your time with this chapter. And finally, we're going to determine unapplied, overapplied or underapplied factory overhead and how we do adjustments for that. Okay, so starting out just with the basic idea of cost accounting. What is cost accounting, right? The last chapter we talked about period costs and product costs. And so the idea of cost accounting is really, looking at those product costs, measuring them, recording them, and reporting them specifically to product costs, right? And remember that a product cost is any cost that's directly related to the production of a product versus period costs, which could be things, expenses related to operating the business, but they're sales or administrative costs. Those would be period costs. Whereas product costs here, as we're talking about, are all the costs that we incur directly related to the production of a product. We need these costs because then we can answer questions like which product should we produce, what price are we going to charge for a product, what amounts to produce, etc. And specifically when it comes to job order costing, that system of cost accounting is really going to be useful for custom type of work. If a company does custom work. So here's an example, a customized wedding invitation, for example. And if we're going to price that job that we're doing for a client, for example, at, whatever our cost is plus a markup so that we earn some profit on doing this work, we need to figure out the cost of that job. And then from that, we can figure out, okay, well, then we're going to charge the customer whatever extra cost on top of that for us to earn revenue. So from the perspective of cost accounting systems, in accounting 2, we touched on this a little bit. Financial accounting, previously we will have touched on this. The fact that there's perpetual inventory systems and there's periodic systems. And typically you want to go with the perpetual system. That would be more ideal because that's a system that basically anytime a product is sold, it will record the inventory transactions automatically at that point of sale so that inventory levels are always kept up to date. Cost of goods sold is constant. It's perpetual, as the work name implies, versus periodic, where you would basically go out and do an inventory count at some interval, and you would see what's still there and what's not, and then you would back into cost of goods sold by comparing what's still on hand, essentially, versus what's gone. What's gone would be cost of goods sold. So that is a more antiquated system that's not as useful. Perpetual is what we want to see. And so that's just kind of the background of, inventory systems. When it comes to these cost accounting systems, like we just talked about, there's a job order cost system. That's what we're going to focus on in Chapter 2. And then there's process cost system, which we will focus on in Chapter 3. So job order production, as this says in this one, process costing, Chapter 3. So forget about that for the immediate moment. But job costing here is used for production of large, unique, or high-cost items. Like I said before, customized kind of items are what kind of falls in this category. Built to order, in other words, custom, rather than mass-produced. Many costs can be directly traced to each job. So if you're doing a large, unique job for someone, or just a unique job in general, it doesn't have to be large, wedding invitations or something, but those wedding invitations will be unique to that customer depending on the type of paper they want, the design they want, so on and so forth. And we're going to be able to track the product costs that we have incurred as we produce that product for that customer, and we can pretty easily trace, as they mention here, those costs that we incur in the production of that product directly to that job. So if customer Smith is having us create a certain type of wedding invitation, using a job order costing system is beneficial when we can look at customer Smith's order and say, okay, here's all the paper that we use for that specific unique job, and it cost us this much. Here's all the labor that went into creating customer Smith's job, and the labor costs were this much. And then compare that with process costing, which again, excuse me, we'll chat about in chapter 3. But process costing is really beneficial when it is homogeneous products, more mass produced. Like think of like cereal or something. There's no way to specifically trace costs easily into one box of, cornflakes or something, versus a custom wedding invitation where you've been tracking all the costs that went into that. That's where job costing is beneficial. And here's some examples, like we said. Special order printing, building construction, every building is going to be different. So all those costs are going to be aggregated. And it can be used, like we're going to focus in on manufacturing companies in this class and in this chapter mostly. But do think about like at a hospital or a law firm or an accounting firm, for that example. Public accounting is very much this way, where if you are a public accounting employee, and you're working on some type of job for a client, one thing that you have to do is you have to bill all your time to that client. So if you spent 3 hours working on a specific job for a client as an accountant, then you'll want to go into the time tracking system, and somewhere, whatever that system is, you're going to put in that I spent 3 hours on this job for customer X, and then I spent another 2 hours on customer Y. And the reason why we need to do that is because there's a custom bill that's going to go out to that client, and that price that we charge them is based on all the work that we had to do for their job. Right. And similarly, like with a hospital, every patient who comes in is going to be unique. They're going to receive a unique bill. And so a hospital is going to aggregate all the services that customer, that was provided to that customer when they were, or the patient, I guess I should say, when they arrive at the hospital. So it's just really about being able to track costs and assign them to a specific customer or patient, client, so on and so forth. And it can be used, so you can be used in a service industry way as well. Some of the events when we're doing job order costing, we need to have there is a custom order that comes in. We're going to need to predict the costs. And then we would, kind of to prepare an initial estimate for that job, to tell the customer, we negotiate a sales price, based on that information, and let the customer decide whether they want to pursue that job, and then schedule the job and do it. So pretty basic, normal stuff we would expect in the process of providing services or preparing products for a customer. Nothing too crazy there, I don't think. The flow of job order production activities. So this ties kind of back to, harkens back to chapter 1. So we, don't forget your main categories of product costs. Remember, raw materials, factory overhead, and factory labor. And then with raw materials and factory labor, again, as I mentioned before with job costing, the idea is that we can pretty easily, or at least feasibly allocate, track how much labor went into a certain job, like with my CPA example of spending 3 hours, on customer X and maybe 2 hours on customer Y. So when we want to make a bill for that customer, we want to account for the fact that we spent 3 hours of, that employee's labor, which costs the company money. You're paying the employee. So we want to be repaid by the customer to account for the costs associated with that employee's time that we were able to directly allocate to that job. And then in a production environment, with raw materials, same thing. If you're making a custom cake or something for a wedding or whatever, depending on how big that cake is, that's going to play into how the price is that you charge the customer, because that's going to be a bigger cake. Requires more raw materials essentially. And again, with job order costing, it's a unique job. Every wedding cake that we're in this hypothetical scenario is unique to that client's demands, whatever their desires, I guess I should say. And so you would be able to track all the flour used in that specific cake, the sugar, the fondant, just all the raw materials, right? And then there's a portion of factory overhead, like we talked about before. Overhead is all the other stuff, the utilities for the factory or for the bakery, and the supervisor salaries that are overseeing the direct labor and things like that. And so we need to figure out a way to allocate these costs. So despite the fact that job order costing does directly allocate materials and labor to a specific job, we do have to do some extra work to allocate, and we will still, allocate, I guess I should say, factory overhead to this specific job, but we can't just do it on the basis of, like we can with the materials and labor, where we can just track that and say, oh yeah, we spent, 2 hours of labor on it, and we use this much flour and sugar, and, therefore that's that much cost. With factory overhead, things like utilities for the whole month cannot be as easily, allocated or just directly allocated, I guess I should say, to a specific job. It's not, if you have the lights on all month and you're working on different jobs, it would be a lot harder or impossible really to look at all your individual products you made and say, oh yeah, 20% of our utilities went to this one and 10% went to that. And same thing with like a factory supervisor salary. They might just be out there overseeing the factory labor. So it's not feasible to have, if you made 10 individual products that month, whatever your business is, it would be not really feasible to allocate, 20% of the factory supervisor salary to the first product and 5% to the next one, because they're not directly working on those products. Again, that's overhead. And we'll talk about that quite a bit and do a lot of practice with this allocation, but do just keep that in mind. So anyway, once we get all our costs, directed into our work in process for this unique job, we track all those. Once the job's finished, it goes to finished goods, and we sell it to that customer. So we already covered this in chapter 1, the basic flow of things, still the same. Let's see, job order cost documents. So as far as the documents go, as I was mentioning previously, we want to track, the amount of materials. Like if it was a cake, for example, like I was saying, a unique wedding cake, we would want to track how much of those materials went into that cake. How much flour, how much sugar, how much fondant, how much whatever it is, the materials that you use. And maybe those could get expensive. I mean, some of those things seem like low cost, but maybe you're doing a fancy cake that has some real special decorations on it. So you want to be able to have some sort of tracking system that when you're looking at the job being completed, that wedding cake being completed, you're able to see, okay, we used this much of this ingredient, this much of this ingredient, this much. And so you can track all those costs that you have incurred as a business. And then we're able to know what the cost was for us to make that cake, so we price it appropriately to earn the kind of profit margin that we want to, and that we've agreed on with the customer essentially. Same thing with labor. As employees work on a job, we're going to want to have them tracking their time, like I said before with the CPA thing. But the cake example could be the same. Maybe you have one baker and they spend 3 hours of their day working on one wedding cake, and then that's all the time they spent. And then they start on some other job. You want them to put 3 hours, so we know how much time it took and how much wage expense we incurred as a company to produce that product. And then, like I mentioned before, factory overhead, and that is allocated based on a predetermined overhead rate. And hold that loosely in the back of your mind. We'll return to how you do that. It's a little tricky, not super hard, but it's definitely something that's more involved than just someone putting on this job cost sheet that we used X amount of ingredient this and X amount of hours. So, and this is just kind of an example. Nowadays, computerized systems would be dominant. These slides are from 2007, so they're a little outdated maybe in some ways, but the general idea is the same. This kind of looks like a paper ticket you would have had somewhere in the old days in a factory. Nowadays, there's computer systems to track these things. But the general idea is still the same. By some measure, which is probably a lot of manual work, someone is having to put the data in here, allocate their time to what they were doing. Someone's tracking the amount of ingredients we're using, so on and so forth. And so this just kind of says the same thing. Materials requisition form is something that, could be used for tracking the raw materials used. There could be a separate form that goes out to say, hey, I'm using, this is alarm systems, I guess they're creating or something. So this example could say, I need this much wiring for this job. So a separate kind of underlying requisition form that tells the company how much of the materials went into producing this product. So, there's just a few little things about this. All these could be unique. They're all more automated now. You would have maybe some kind of request and then an approval process or something. You definitely want to know how much the quantity is. We want to keep track of these things. And kind of the point of highlighting these things are that having a dedicated system that tracks things and has pre-numbered, pre-printed forms, so forms just don't go missing, that kind of thing, is just all good internal controls to make sure that the process is working well. So this is just kind of an example. This would be like a materials ledger. So that if this is wiring, this could be flour in our example for cakes. And basically what this would be saying is, here's the total that we had at the start of the month. We received some more of the materials, and then someone filled out this requisition form, and we supplied that employee with the amount of materials that they needed to complete the job. And this isn't to say that this is how every company does it or this is standard. This is just an example of the types of source records and documents that you would need in a system like this. And it doesn't mean that you would always have a system where someone goes and requests flour, from the boss or something, or from the supervisor. This might be done more informally for different types of businesses, but it kind of gives you an idea that you need a lot of forms and tracking methods to be able to, effectively track all the materials that are being used and labor and everything. So that's materials. Okay, now we finished this job, or we know all the costs that went into that. So our direct materials then would be the total there. The labor comes off of like a time ticket or some time system, And so this was basically just some system that employees can basically say, I spent, 3 hours on this job. This is the hourly rate. So therefore the total cost of the company related to that employee's labor is $60. And then that goes into the cost of the job as well there. So now we know materials, we know labor. And now we got to do this predetermined overhead rate to allocate the overhead. So the way that they do it in this example is we basically just come up with some reasonable formula to allocate overhead costs, or expected overhead costs, really is what I should say. And so the way that we're doing it here is we are saying that every time that we incur direct labor, we're just going to immediately allocate 160% of that time. So the way to do that would be take this times 1.6, and that gives us 96. So we're basically just coming up with an estimate of the overhead we think this job probably took, and we're basing that on direct labor costs. So it's just a reasonable method too. It's not the only method you could use to make that allocation. But here in this example, that's what we've done. And so the system, or someone manually doing this, you as the student, you will have to manually do this in our homework and in-class exercises. But we've come up with this method or this allocation rate, and we say, okay, now we know we had 60 direct labor cost. and we have already planned to put 160% of labor costs in as overhead. And so therefore we're going to charge $96 of overhead on this job. And what we'll see here shortly, we'll talk about, is that is just an estimate, and you could be over, this could be too much, it could be too little, and that's not something we really know until later. And so as we go through these slides, we'll see a part where we kind of talk about how you deal with that if you are over or under applied for overhead. So here's an example of kind of how they came up with that 160%. So we use a predetermined overhead rate, POHR, based on direct labor cost, right? And so we come up with this 160% actually before the year even starts, right? This is part of our budgeting process the year before. So maybe sometime in quarter 4, maybe around Thanksgiving or something, November, October, December, as we are planning and forecasting activity in our company for the next year, starting in January, we might do some work and we come up with some numbers. We estimate, for example, that we're going to have $200,000 of total overhead cost for the entire following year. And then we also estimate our total direct labor cost for the entire year here, $125,000. And then if this is and again, these are not US GAAP. This is based on us as managers just coming up with a reasonable method. You could use just something different than direct labor costs as well. You could use machine hours. You could use any number of things. But in this instance, and a lot of our homework problems here in Chapter 2 especially, we use just direct labor costs. They're very easy to track and easy to use as an allocation base, so that makes it nice. And so basically what we say is these are both estimates of what we think overhead and total direct labor is going to be. And so therefore, if we just take the overhead divided by that expected direct labor, then basically what we're saying is for every dollar of manufacturing overhead cost, every dollar of direct labor cost, excuse me, we would be incurring, per our estimates, $1.60 of overhead, or 160% basically. And then every time we incur any direct labor cost for a job, then we just immediately apply 160%. So that's where that comes from, and we'll practice with that a bit. Okay, just a summarized cost flow here, material requisition forms. Those are going to our job cost sheets. This tracks all the costs. This is the materials getting used. Some of that materials goes to overhead, and some of it is indirect materials. It's not the flour and sugar that goes into a bread or a cake or whatever, but it could be the WD-40 that's used on the mixing machinery and stuff like that. And so some of those materials that we get are not just the direct materials, but some of them are also indirect, and those go into overhead. And then same thing from a time ticket, perspective. Some of the employees' time is going to be direct. The ones actually, doing the labor, making the cakes directly, mixing the stuff and putting it all together. And then some of the employee time is going to be indirect. That might be things like that factory supervisor or the factory janitor or something. That's indirect labor, and we would also get that off the time ticket, but that wouldn't go to the job right away. It would go instead to the factory overhead account. Okay, so here's a little bit of a T account description or representation of this. So that we have raw materials, work in process, goods in process, but we're going to say work in process, that term, WIP, and then factory overhead down here. And so the debit that we see here is just the increase in raw materials. And like I mentioned before, this can include things that are direct materials, like the flour and sugar and stuff for bread or cakes or whatever. And then it could also include the indirect materials like WD-40 or some packaging materials or glue or I don't know, whatever it might be. That's not the stuff that goes directly into the product, but is part of the production process. So that's all included on the increase side of our asset of raw materials inventory account. And then when we use this stuff up, we take some of that out, so we're crediting it to reduce that initial purchase of those materials, with the direct stuff going into WIP and the indirect going into factory overhead down here. And then if we want to kind of add a little bit more, then we see this factory payroll account. And so we have total payroll that we've incurred. Again, a portion of that is direct, the people on the line actually making the products. That goes into WIP as well. So there's the materials, there's the labor. And some of the payroll in the factory is indirect. It could be the supervisor or the janitor. And so that also goes into the factory overhead account. And then over here in the overhead account, and we'll practice with this. Just get the basic concept here. Don't worry too much about memorizing any of this, arrows going every which way. We'll practice with this quite a bit. But the idea is that the actual costs here for labor and materials goes on the debit side of the overhead account. And then when we are putting that allocated overhead, that 160% of direct labor, we're going to put the debit to the goods, to the WIP. That's adding into the value of the product there in WIP, but it's not based on the actual cost paid. It's just that estimated percentage of direct labor, 160%, right? And so that goes on the credit side. And how we compare how we compare whether our budgets were accurate enough is we compare these two things at the end of the period. We compare actual overhead costs to estimated applied overhead. And then if it's depending on which side is bigger, more or less, then we'll need to actually look at how to adjust that. And we'll do that later. And we'll practice it a bunch in class too. So that's a little bit of a confusing concept, I think, if you're hearing that for the first time. So don't worry, just hold that very loosely in your mind, and then we'll practice with it a whole bunch. Okay, and then we're going to finish our, so now we have overhead, labor, and materials, right? That was all the stuff that went into WIP. It's in WIP, so it's getting, let's say it's a bakery, it's getting mixed together. This is all the stuff getting all mixed up. The product's getting mixed up, and all the costs are also kind of getting mixed up here as well to create a total. And then once it's finished, we just say this was all together was $10,000 or something, whatever, just hypothetically speaking. If all these costs together were $10,000, and then when we finish, when they're finished goods, we're done mixing them and packaging and everything, then we would credit this for $10,000, for example, to zero out the WIP. So no more WIP because it's finished. Credit there, closes it, makes it go zero. And then the debit on the finished goods side of inventory, this asset inventory account, these both are, then we just move those costs over to finished goods, basically. And then it sits there as finished goods. And a lot of times with these job costing type jobs where they're custom, they're individual, these aren't things that hopefully would be sitting on a shelf necessarily. This is just more of a custom job that you finish for a client, for example, wedding invitations or a cake or something. And so you already know that the product's going to be sold. So hopefully it sells quickly. The customer comes in and picks it up. You get paid. And then the final, kind of accounting step is that the cost of goods sold gets credited for say it was, 10,000 or whatever. So it's gone. We don't have any more finished goods because we sold it. And instead that moves over to cost of goods sold, like we've talked about previously. And don't like I'm saying, this is just an overview. We'll practice a lot with this. I know it's a little bit like overwhelming maybe with all these arrows and T accounts and colors and everything, but hopefully that general idea of this is sort of sinking in, and we'll do a lot of hands-on work to practice with this whole flow. And that's where I think it's really going to solidify. Okay, so now let's move we're going to on to the next slide here, where we are going to talk about that predetermined overhead rate a little bit more. This is just kind of saying, hey, wait, how does this work again? And this employee saying, we multiply the predetermined overhead rate, that was the 160% we saw previously, times the number of activity units, and we use direct labor costs for those activity units. But again, it's just activity units that we're using. It could be something different, not just labor costs, could be labor hours, machine hours, something else. Again, this is where managerial accounting really differs from financial accounting, where most of the time in financial accounting, it would tell you exactly what you have to do. But here, when we are just trying to make a good decision about, how do we allocate all these overhead costs in a fashion that makes sense, we have to pick some method to do that. And this is just one of those types of methods. And then also we have to select what the base would be to do the allocation, and we could choose different things, but Like in this example, we picked direct labor cost. And then this guy, I don't get it. Show me an example. So I get it. It's kind of tricky. So we'll practice with this again quite a bit, but let's look at this question just to see some numbers here. So if Fishco budgets overhead at 200,000, estimates this activity to be 25,000 direct labor hours, what is the POHR per direct labor hour? Again, now we're using direct labor hour, not direct labor cost. So that's a little different. And so basically what we would want to do is take that overhead divided by the 25,000 of the hours. So 200,000 estimated budgeted overhead costs divided by 25,000 estimated hours. That means per our estimates, it's going to be $8 of overhead per direct labor hour, right? And then so every time we have a direct labor hour for a given job, we just multiply it by 8 to get the allocated overhead amount. And then this is the continuation of that, basically what I just said. So if we actually work 24,000 direct labor hours, we would take 24,000 times 8 to get 192,000, and that would be assigned, to all the jobs that company did, Fishco did during the year, and we would be allocating those to each individual job based on how many direct labor hours that individual job had, associated with it and recorded to it. Now, you might be saying, why the heck are we doing that? Like, why are we doing this weird process for overhead? And there's a number of different reasons why that we'll explain here. As opposed to tracking materials and labor, which is relatively simple, because someone's working on that job, they can just say how many hours they spent on it, right? Someone is using a certain amount of materials for a given job, they can track it on all those material requisition forms. Relatively easy to track. But overhead is a whole litany of different things, right? It's utilities, it's property taxes, it's supervisor salaries, it's janitor salaries. It could be little materials like WD-40 that are just used intermittently to make sure the machines are running well, right? And so it's not that we could just somehow, it's not easy or feasible for us to take all of those costs and then look at customer Smith's wedding cake and say, oh, okay, yes, exactly this much of that utilities and this much of the supervisor time. And, maybe we only use WD-40 every other month, but somehow we're going to know that we needed this little portion to apply to that job. So it would be impossible, basically, to somehow really develop some method to apply all those costs to a given job, unless maybe you only have one job during the year, I suppose. If you only had one job, then you could basically get to the end of the year and say every overhead cost that we incurred all went to that one job, right? But that's not the normal case for most companies. You're going to have lots of different jobs. And so it's not so easy to allocate those. But the other problem is, even if you had one job during the year and you could just say, okay, every overhead cost we incurred all just went to that job, so we know that's the right amount of overhead. Even if that was the case, you wouldn't know what those costs were until later. And that's what it's saying here. They're not incurred uniformly during the year. Like, for example, utility bills, those, come throughout the year essentially and stuff. And maybe WD-40 is used intermittently, so on and so forth. So as opposed to direct materials and labor, which are directly used when we're making the product, all these other overhead costs are kind of, disconnected from that actual production of that one cost. And also we need to be allocating costs to these jobs like on day one, right? If we have a job that we're working on January 1st and it's going to be finished on January 1st, we don't have all the information for all the overhead costs yet. So that's why we use an estimated or budgeted amount based on, some base like direct labor hours or direct labor cost in order to come up with some budgeted best guess overhead that we apply to that, so that when we charge the customer a price, it does include overhead. But whether or not we did it perfect, it can never be done perfectly because our budget could never actually account for all the little overhead things we're going to, incur during the upcoming year. But the closer we get to the actual numbers, the less we will need to adjust it at the end of the year, basically. And what that means also is, compared to what our actual costs are, as a company, we would kind of rather be on the side of estimating too high, and therefore assuming that our overhead costs are a little bit higher, so our price is a little higher to the customer to account for anything. As long as the customer is happy with the price and they're agreeing to purchase the thing, then that's the only downside is if you estimated overhead too high, they might say, whoa, that's too expensive. I don't want this product. So as long as it's reasonable, the situation you don't want to have occur is you don't want to underestimate overhead costs, therefore charging the client a lower amount. And then at the end of the year, you realize, oh no, we had way more overhead costs than we thought we were or that we budgeted for. And we're not charging enough cross price, passing that on to our customers to absorb those overhead costs that we did have to incur. That could lead to significant losses overall for the company. So just some things to think about. It's a little tricky, but we'll practice. So, okay. So again, the overhead rate is based on budgeted estimates. And then what happens if the actual results differ? And they will differ. I mean, this is not a what happens if. It is always the case that you will never be able to have a crystal ball that exactly budgeted, the prior year you budgeted the exact amount of overhead costs that you would incur in the following year. That's impossible, or any period. Right, so you will always either have underapplied or overapplied overhead. And if whatever one we have, either we estimated too low of our overhead costs or we estimated too high, regardless, we're just going to go in and manually adjust cost of goods sold at the end of the period to account for that essentially and to close out the overhead account. And I guess we have an example here. So if we want to adjust overhead and underapplied, adjusting of applied and underapplied overhead. So if the actual costs go on the debit side of the overhead account, the estimated applied allocated overhead goes on the right side. Just keep that in mind. Kind of looks like a T account, and that's how it is. If you had more overhead applied than you actually incurred, you budgeted the prior year that you were going to have $200,000 of overhead this year, but it actually turned out you only had $175,000. And so the whole year you were estimating and applying $200,000 of budgeted overhead to your customers' jobs. If you get to the end of the year and you're like, oh, we didn't actually have that much cost, then your overhead side over here, allocated side, I should say, would be higher. And we would need to, and it's over applied in that instance, and we would need to do a debit to balance this out and bring it to zero. If you estimated that your budgeted overhead would be $200,000, in the prior year, and you're using that as an allocation rate, and then you get to the end of the year and you realize, oh dang, it turned out we actually had $250,000 of overhead this year, then you had not been charging your customers enough overhead. And so the actual, on the debit side of that overhead account is higher in this instance than the applied amount. And this is a okay scenario, because as long as your customers are buying, happy with the prices they're paying, and this is good generally. I mean, maybe you could be more competitive if you could lower your costs, to really account for everything. But this gives you a buffer of extra profit that you're making, to account for unforeseen stuff in the future or just to earn extra profit. This instance, though, when you didn't charge enough overhead to your customers, then you could be incurring losses right away, because you've got actual expenses here of overhead things you're paying for, and you're not accounting enough of that necessarily in the price that you charge the customer. So this is the worst. This is maybe not as good if you're not able to get customers because your prices are too high or something, but this means that, your customers might be really happy. Wow, you got great prices. And then you get to the end of the year and go, oh crap, we didn't charge enough to account. We have losses now because we didn't allocate enough overhead to these jobs. So we'll work on some homework problems for that. I mean, this is sort of just the idea here. If you're underapplied, cost of goods sold is too low, basically. And so at the end of the year, we just increase cost of goods sold. Kind of from this idea, we would increase cost of goods sold to balance this out. If it was actual overhead was overapplied, that means cost of goods sold is too high. We would decrease it. So this is all a little theoretical, and it'll make a lot more sense when we do some problems. So just keep this loosely in your mind about how this all works. Mostly at this point, if you just sort of have some familiarity with these concepts, once we do the actual exercises and you put the pen to the paper, then you're gonna connect the dots. Okay, so again, let's go back to Fishco. Let's say we had actual overhead costs of $180,000. we applied 192,000 of overhead to jobs based on our predetermined overhead rate of $8 per direct labor hour. And so if actual overhead was 180, applied was 192, that means that our applied was higher than our estimated, this is our estimated. Our applied / estimated was higher than our actual. That means that we were over applied, right? So again, that's kind of a good situation, at least. It's better than being under applied, because maybe we could have charged the customers less and still paid for all our overhead, which is cool. But, there's nothing in the free market economy that we operate in that says that you can't price your product basically however you want. If a customer is willing to pay that price, then great. So again, applied overhead, less actual overhead means that we kind of like overestimated what our overhead cost would be and applied that to each job in that manner. And when it came all said and done, we actually came in under budget by about 12,000. So good for us, or good for Fishco. I don't know if Fishco is these slides are weird too, by the way, just some of the graphic arts, but that's cool. We'll go with it. Question. Okay, so the difference between Fishco's actual and applied overhead will result in an adjustment that decreases cost of goods sold. Do we need to decrease it? Basically what we're saying is we will have too much on the the overhead applied side. So what we're going to do to balance this out would be to debit this overhead account, and then we would be crediting our cost of goods sold account. So we would say, yes, it's going to reduce cost of goods sold. That's pretty theoretical. Don't hurt your brain trying to think about it. Same for me. I've done this a long time, and it was hard for me to get my head around this until doing the actual problems. But loosely keep in your mind the idea that if you've incurred more if you have less actual cost than you do estimated, just in the effort of accounting for that differently on our cost of goods sold so that we can see what our real profit was, then we'll do a journal entry to reduce our cost of goods sold, because that cost of goods sold currently has that amount built into it of the too high overhead costs. So I don't know, that sounds really complicated and it kind of is. So very loosely hold that, and we will look at that in terms of journal entries and T accounts, and it will be clear after we go through that. Okay, so speaking of journal entries, again, they're going to kind of walk us through some of this, and let's just take this in for now, and then we'll practice. But two main steps for job order costing. Step one is to accumulate costs. So we're accumulating raw materials inventory, factory labor, overhead, etc. So when we say accumulate, this is like us just buying all of the raw materials. Again, raw materials could both include direct materials like flour and sugar for a bakery, and it could also include indirect materials for things like WD-40, for the mixing machines and stuff like that. So that raw materials is not direct materials. That's two different things. The raw materials inventory can include both indirect materials, the WD-40, and the direct materials, the cake stuff, flour, sugar, etc. Factory labor, we're going to track that, or accumulate that out of our payroll system. This is just all the cost of everyone who works in the factory. And again, some of those employees in the factory are direct labor, the ones actually mixing the stuff and making the food and everything in our bakery scenario. And then the indirect labor would be maybe things like janitor, factory mechanic, factory supervisor, labor supervisor. So anything that's not directly involved in that direct production process. But so you can see direct and indirect is inside of both of these. And then overhead, we're just accumulating that as we pay bills for things like property taxes, as we record depreciation on the factory equipment and maybe the factory building, all those overhead costs. So the indirect costs, too, that are associated in this will be put into overhead as we go. So then the step two is to assign those costs. So once we have all the materials and all the labor that went into stuff, then we basically go into a journal entry and put in as a debit the amount. Well, this is the first part. Sorry. This is just the accumulating. So this is still accumulate. So journal entries for accumulating. This is us just buying some raw materials. Again, that could be sugar and flour, and it could also be WD-40. And again, this should hopefully seem familiar now. We did chapter 0, and this ties back to like financial accounting. We're just buying some stuff, right? So it's raw materials inventory, and we've got it in our warehouse now, sitting on a shelf somewhere. Cool. And then as we start to record costs and actually track, okay, we say job number 1 used a certain amount of raw materials. This is where we're going to put that into WIP, the amount of the direct materials. So we're taking that out of the raw materials inventory. So step 1 is we buy the raw materials, is accumulating. We buy them here, it's sitting on a shelf. Then we start using that flour and sugar, and we credit raw materials to take it out of that raw materials inventory and move it into the work in process inventory. So it's moving through that different steps from raw materials to work in process, and then finally to finished goods. And then once it's sold, it'll turn into cost of goods sold. Now, there's also a component in this raw materials that's indirect stuff. Like I said, the WD-40. So we can also reduce that raw materials inventory here with the credit and put some of that cost for those things that we used of those raw materials into factory overhead. So again, raw materials has both direct materials and indirect. And then factory payroll, kind of the same thing. This is basically us saying we paid out everybody in the factory for their payroll here. And that initial journal entry to accumulate that, we put it in this factory payroll account. And then we go through that total amount of factory payroll, and we put some of that into the jobs that was actually, the direct labor spent on the actual people who were working on this project, touching the materials that were used and converting it into the final product. And then a portion of that factory payroll is all the indirect stuff. So that goes to overhead. So again, that's janitor, mechanic, supervisors, in the factory, but people who are not directly on the production line. Whereas this would be everyone who's labor, who's on the production line, that just all goes into WIP directly for that job. And then, there's other factory overhead things too, not just, so here we had indirect labor, here we had indirect materials going into overhead. But then there's just a bunch of other overhead stuff too. We have insurance, utilities, depreciation, right? All kinds of stuff can also go into overhead. So overhead is going to have all kinds of stuff. Indirect materials, WD-40, indirect labor, supervisors and janitors, salaries, and then it could have insurance, utilities, property taxes, depreciation, all kinds of stuff. And that's all going into the debit side as those payments are made, basically. And then here we're going to be doing that allocation essentially. So that you can see the debit to overhead is all the actual costs that we incur for overhead. And then the credit to overhead here is us applying that predetermined overhead rate, the 160% basically. So we credit the overhead account there. Again, it's confusing without seeing a T account and working through it. I get it, but just, hold this loosely. So we credit the overhead account and we debit WIP. So what's going into WIP is the estimated amount, and that's crediting the overhead account. Whereas everything that's debiting the overhead account, these amounts are for actuals. And that gets us back to this whole idea that we saw earlier. So the actuals on the debit side and the estimated applied on the credit side. And that's what's kind of showing here with the journal entries. And then, so that all goes into goods work in process, WIP. And then once WIP is done, then we just credit WIP and debit the finished goods inventory. So it's now moved across all these inventory categories, and it's finally in finished goods. We're done with the whole thing. And then we sell it. And here's that 4-part journal entry that we looked at in chapter 0. And in financial, you guys saw this a lot, where cost of goods sold then, is that cost of the finished goods process, finished goods inventory. We just debit the cost, right? So now it becomes expense that goes on our income statement to calculate gross profit. We credit the finished goods inventory account to indicate that this thing is out of here. We don't have that inventory anymore. It's sold to the customer. And then we record the sales amount that the customer paid as revenue, and, either cash or in this example, on credit and accounts receivable that we will be paid from the customer eventually. So this is the same kind of journal entry again that you'd see with a merchandiser. It's just all this other stuff before that process that we have to account for because we're doing manufacturing and job order costing too specifically. So that's the journal entries. I think that brings us, to the end of the chapter there. Hopefully some of that sunk in. I really think chapter 2 is a pretty tricky one in terms of the conceptual part of it and trying see and actually understanding all of this. And I think it's good to watch the lecture, do the notes and all that. But as we go through this entire chapter, I really think that this is material and information that you're going to need a decent amount of practice, not just one practice session, multiple times of working through to get the answers right. And to understand what this all means, essentially. So don't worry if you feel a little bit overwhelmed at this point. And now as we've gotten to the end, I just realized I was going to try and, as I'm doing these lecture videos, I do want to try and highlight our notes answers as we go so you can have those for you. So I've now got my notes answers pulled up and we'll just go through those one by one here. So number 1 says, what are the 2 primary cost accounting systems and how are costs assigned? And so if you remember, that comes back to the, sorry, let me just do something here, single page. Okay, so that was, things going slow, sorry. Process costing and job costing, chapter 2, we're talking about job costing right now. And so in job order costing, that's where the costs are assigned to specific jobs or batches, large unique ones. And then process costing, the other primary cost accounting system, is where we are applying costs to departments or processes and we average the costs out essentially. And that's for things like cereal or other homogeneous mass-produced products that aren't something that we can easily say, oh yeah, our employee spent 3 hours on this one job, right? It's impossible to say that for one box of cereal. Oh yeah, our employee spent this much time on that individual box number 105723 or something. It's very not, you wouldn't use job costing for that. That's where process costing comes into play. Number 2 is kind of along that same line. What type of companies would utilize each system? And the best way, we kind of just like what we just explained there, is that job order costing will be for large, unique, high-cost items, not mass-produced, where we can directly trace the cost to the job. And then process costing is more so where you have those mass-produced similar products like food processors, oil refineries, chemical manufacturers, some examples. What type of account is work in process? And that will be it's just, as we've seen here, it's an inventory account, right? It's one of the 3 inventory account stages here as we go. Raw materials is inventory, work in process is inventory, and finished goods is inventory, which is somewhere at the end of this thing here. The 3rd, finished goods, that's inventory as well. What 3 accounts are used to accumulate manufacturing costs as they are incurred? As these costs are incurred, are they normally debited or credited? And what is the offset? That one's a little tricky mouthful there. But the three accounts that we use to accumulate costs here, let me find the best place to show that. Sorry, going back here, but it was raw materials, factory overhead, raw materials, labor, and factory overhead. I mean, all 3 of these basically. And when it says, are these costs normally debited or credited? Raw materials is debited when it's increased, when you're purchasing something. Labor is debited when we are accumulating those payroll costs. Manufacturing overhead, they're all debited essentially, right? And then some of the offsetting accounts that we would have for those payments would be things like cash, accounts payable, wages payable, so on and so forth. So it's really just asking about what is and we saw this really mostly down here, what, accounts payables and offsetting when we're purchasing, debiting raw materials to increase it. Factory payroll, we're paying cash and we're debiting factory payroll to increase that. And then, you could have wages payable. So here's kind of the cash being paid, accumulated depreciation, reducing prepaid insurance, so on and so forth. So these are all the offsetting accounts, but typically it's debits that are going to increase those. They're assets, they're inventory accounts, right? So that makes sense. Our notes, question number 5 said accumulated costs, raw materials, factory labor, and manufacturing overhead, MOH is manufacturing overhead, are assigned periodically to which accounts? And that's really going to be where we're going with this, where they go into WIP, right? That's the important intermediate step. Maybe this will help me navigate just so I can go back to the specific spots. So here, this is all going to go into goods in process, but WIP, work in process. And then it goes into finished goods eventually, from WIP to finished goods. So number 5, accumulated, costs, how are they periodically assigned to which accounts? That would be to work in process inventory. Number 6, on what document are the cost of individual jobs recorded? And that was the job cost sheet, right? That's got all the costs of this individual job noted out. Number 7, what documents are used to assign these costs to job cost sheets and support accounting entries? That's going to be the requisition sheets and the employee time tickets, basically, right? So those extra subsidiary reports here's the time ticket, and then we had like a materials ledger, and we had the materials requisition card. It's all electronic nowadays, but something of that. It accomplishes the same goal still. Okay, what's the next one? So number 7 was material requisition slips and employee time tickets. And number 8, what journal entries are required to assign raw materials and factory labor to work in process overhead? And getting back to the end here, when we were looking at these, we want to assigning raw materials, like this one right here, WIP inventory. We're crediting raw materials, we're debiting WIP. So you debit WIP, credit raw materials. That's the raw materials part. And then if we want to think about that from a payroll perspective, we're going to credit factory payroll and debit WIP to assign that cost into the work in process. So again, for direct materials, debit WIP, credit raw materials. For direct labor, we're going to debit WIP inventory and credit factory labor or wages payable, depending on how the accounting was done initially. Okay, let's continue on here. So that was number 8. And then notes, question number 9 says, what journal entry is required to assign overhead? So MOH, manufacturing overhead, to WIP. And then we saw that one here also. So let's keep looking through. That's finished goods. Where's our overhead? Okay, well, so we've got debit factory overhead, credit factory payroll for indirect labor. That's part of overhead. We've got debit factory overhead, credit raw materials inventory. That's part of the raw materials piece. And then when we want to move all these costs to the finished good, or to the work in process, I should say, then we are going to want to, let's see if I can find that here. So then we're going to want to debit WIP and credit factory overhead. Right? So, and we're doing this by using that predetermined. So question number 9, the specific answer really it's looking for is this is the journal entry used to assign overhead to WIP. That would be debiting WIP, crediting factory overhead or manufacturing overhead. Number 10, how is overhead applied to jobs? Why do we use these methods? Where does the year-end adjustment go? So this is kind of like what we're talking about right here. We're applying this using a predetermined overhead rate. That's how it's applied to jobs. Why do we use this method? It's used in order to provide timely and consistent information when we're trying to aggregate so many different overhead costs. And at the end of the year, when there's over or under applied overhead, we're going to close that out to cost of goods sold. Sorry, I think my audio just dropped out for that section just a little bit. So hopefully that wasn't too funky audio, but close to the end here. So let's just finish this thing out. And then notes, question number 11, when a job is completed and sold, what journal entry is required? And that was the one we looked at the very end and we practiced with in chapter 0. So same thing, once we know our cost of goods sold from doing all that work of allocating and tracking, then we just do the same old 4-part journal entry with cost of goods sold being recorded, finished goods inventory being credited. It's an asset, so credit means it's going away, it's going down. We don't have that finished goods anymore, we sold it. And then on the revenue side, we have sales revenue we want to record for sure. And then we're either going to get accounts receivable or cash, and this will be, the payment that we receive from the customer. So I think that is the end of our notes there. That's notes number 11. And chapter 2. Like I said, chapter 2 is one of the most complex chapters actually when it comes to like journal entries and things of that nature in this class. So if you feel a little bit like brain frazzled after watching this video, that's normal, I would probably say, for better or worse. And then once we just work through this and you follow along with me in the homework videos and we do in-class exercises and all of that extra work, that's when it's really going to gel. But hopefully this at least gave you a decent background here, context to begin that next step of understanding. So, all right, well, thanks everybody. Hope you're having a great day, and I will see you in class or in the next video. All right, thanks. Bye.